a brief run through of at high level some of the main VAT developments, and then talk a little bit about some of the issues that we've been seeing on the zero rating of exported services outside to customers outside, as covered by the Article 33 or Regulation 33 in the VAT regulations for Saudi Arabia. That has been a hugely problematic area for businesses. So I'll run you through just a bit of that legislation, because I think that's as useful as anything, but to outline where some of the problems lie, and then I'll hand across to Martin and Robin, who will then talk you through e-invoicing and the development on real estate transaction tax. So it's been a busy year for VAT, to say the least. We started with a rate of 5%. We started with taxation on all of our land and property apart from residential rentals, and without a global pandemic truly having gripped the world, and things really escalated from there, because obviously in July 2020 we saw the increase of VAT from 5 to 15%, and that was a real game changer for Saudi Arabian VAT. That brought the VAT rate more in line with European rates, albeit they are slightly higher. It's starting to head in that direction, and they've gone out on, Saudi has gone out on its own, past the rest of the GCC that has implemented VAT so far with a 15% rate. So massive change and a huge impact, and that means it's an issue for particularly for businesses that can't recover all of their VAT. Like those businesses engaged in financial services, for example, who are partly exempt. At the very minimum, it's a huge cash flow impact. So we're seeing a huge kind of step change with the way businesses are approaching VAT, because it is now causing them a huge cost, whether that is cash flow, working capital, or indeed an absolute cost. And so what we're seeing now is businesses looking to move to alternative methods of VAT recovery, and to really fine tune and speed up, for example, their VAT recovery process, so that the disruption and the impact of VAT is minimized, because we're now looking at such a significant rate, and with very limited transitional provisions. So if you had a contract that was agreed before the 11th of May 2020, you could potentially continue to treat some of your supplies as 5% to the earlier of the renewal or expiry of that contract, or as a backstop, the 30th of June 2021. And there was a relief for invoices also issued before the 11th of May 2020, where if the supply was delivered after up to, again, the 30th of June 2021, then it may still be eligible for the 5% rate. But that was it. And really what we're seeing now is businesses fully in the grip of the full 15% rate of VAT, and that has a huge impact on some of the other things that we have here on this first slide. We are seeing a huge amount of, and I'll address them in no particular order, but really order of importance in what we're seeing. We are seeing a huge amount of gazette activity. That is through either audit requests for information, the issue of what some of you may have seen in terms of almost provisional assessment notices, that will be crystallized if the requisite information is not provided to the Gazette within the required time period. So really putting a lot of pressure on business to divulge some of their financial data so that the Gazette can check this against their VAT declarations. And we're seeing increased activity in that regard. with Gazette performing more detailed audits of businesses. And what that's meaning is that you know, our records from a VAT perspective in Saudi Arabia, I think, have a little bit of catching up to do, because VAT is a very new tax, and you know, that also impacts the way the tax authority, which itself from a VAT perspective is relatively new, approaches audits, and approaching audits the way that they do, comparing financials to, for example, a trial balance to a VAT return. Often they find errors, and they tend to assess kind of there and then and ask questions later. And what that's then meaning is that you'll see on the top right, I've mentioned VAT controversy. This is effectively the litigation element of VAT, which is now increasing in importance. So we're seeing many cases escalated to not only VAT objection, which is the first stage when you receive a Gazette assessment that you don't agree with. That tends to just be rejected by Gazette immediately, and then it has to go to the GSTC, which is a further appeal committee. And again, we're not seeing a huge amount of favour for the taxpayer at those hearings. That then means if they get an unfavourable decision at GSTC, then we're moving to the higher appeals committee, we're moving to HAC. So a long litigation process, all starting from you know, this Gazette interaction and audits, the finding of mistakes, the disagreement on the technical aspects, which I'll come on to on Article 33, because that's one of the main sticking points and litigation points at the moment through the courts. You know, in amongst all of this, all of the challenge, the 15% rate, the pervasiveness of the Gazette, we have been given a bit of a ray of light, I guess, in that there has been a tax amnesty initiative from the Gazette to allow the fixing of historic mistakes all the way back to from the implementation of VAT in 2018. And that has allowed the correction of VAT positions where businesses may not have registered in time, they may owe money to the tax authority, and it's giving them an opportunity to correct those previous errors, penalty free. Now they still have to pay the VAT, but in terms of being able to have a clean slate, it's a great initiative, particularly when we look at you know, some of the exposures that have been generated from day one of VAT. You know, we're now 3 years into the system being live in Saudi Arabia. There are some big exposures out there. They can be fixed relatively pain-free through the amnesty, which, as long as you submit your declarations, you pay the VAT, or you agree an instalment plan with Gazette by the 31st of December 2020, and it's been extended to that point, you can benefit from not having the penalties, which, in my experience, the penalties, particularly when you look at some of the later periods, these can be as much, if not more, than the tax. So a really great initiative. But there's a lot going on in this landscape. It's moving very quickly, and I would recommend that anyone out there, if you have any exposures that you would like to rectify, use the tax amnesty now, because we don't expect a third or a second extension, but it's always possible. So a lot going on in VAT. The current updates down at the bottom right, that will be covered by Martin and Robin. That's another seismic change: the removal of tax from certain supplies of land and property, the introduction of a new tax, and e-invoicing, which looks like the first step towards real-time information and much more tax authority interaction. So we'll move on to the Article 33 slide now. Article 33, as I mentioned at the start, that allows a business in Saudi Arabia making supplies to someone outside of a member state to zero rate the supply of that service as an export. Now, it's a big issue if that is incorrectly applied. It's even more of an issue now that we have a 15% rate of VAT. Now, like any zero rating, it has strict conditions. And what I thought I'd do is very quickly run through these conditions, and we can talk about it more in the Q&A if anyone would like to. But there are a number of issues with the way that the Gazette applies the zero rating versus how we as tax advisors see it operating, not only from Saudi Arabia, the wider region, but also our experiences from elsewhere in the globe, for example, Europe and Australia. The Gazette seems to have a very narrow interpretation as to how this applies, and they are erring on the side of tax. And it's a big issue if someone applies the zero rate, and they shouldn't have, because that is an absolute tax exposure. Now, as I said, it's a tax exposure of 15%. Now, you're exporting a service to someone, a customer outside of the GCC member states, which for VAT, Saudi Arabia at the moment includes every other country in the world. You can apply the zero rate of VAT. And the conditions for doing that are, one, that your service isn't subject to any sort of place of supply deviation, like services in relation to land. They are deemed to be supplied where the land is located, or electronic services that can be subject to place of supply by virtue of their use and enjoyment. As long as it's not the case, like a legal service or some consulting, then it can be subject to the zero rate, unless a place of supply deviation exists, or, second condition, the customer is considered resident in any member state. Now, as I said, member state at the moment is only Saudi Arabia, and we'll perhaps touch on residence later when Irfan Aladdin joins us. But provided we get through the first two conditions, we can still zero rate our services. Now, this is where it becomes difficult. If the customer or any person benefits directly from the services when that customer is situated in a member state, so at the moment just Saudi Arabia, and the other person is not permitted to deduct input tax on such services in full. Now, this is where it gets difficult with the Gazette, because they can, in a number of instances, look through chains of supply that may circle back to Saudi Arabia. And if for example, a subcontractor providing services to a contractor a contractor in KSA supplying services to the main contractor in Saudi Arabia, say, for example, a legal or consulting service that is then supplied by that main contractor back to a Saudi business, the Gazette actually tends to look through that supply chain to say the absolute benefit it remains in Saudi Arabia. And that's problematic, because otherwise the customer would be, the end customer would be applying the reverse charge on the supply in from the main contractor. But if the subcontractor has to apply VAT on his supply as well, then it's the case that there tends to be a sticking VAT cost that's not really recoverable by anyone, built into, and particularly since we don't have the foreign refund scheme up and running yet, it tends to create an absolute cost within that chain of supply. So that's one difficulty, and we see that typically, in professional services, when we're working with other member firms who are working for international businesses who have business in Saudi Arabia, we can fall foul of this, and we have to be very careful. We would say that our service should be zero rated, because the direct beneficiary actually of our service is the foreign company, but the Gazette can look at this differently. So we've seen assessments in this regard where they look through chains of supply and say that the benefit is in Saudi Arabia, and therefore 5 or 15% VAT should apply. And the other, now provided that third condition isn't met or isn't triggered, we move on to the fourth condition, which is problematic also. And I see this often in the pharmaceuticals industry, where we maybe have some supply and marketing by a distributor that is going on in Saudi Arabia. It is in respect of goods, and the Gazette sees this as directly related to the goods. Now, there's a conflict between a number of pieces of guidance issued by the Gazette on this matter, where one piece of guidance says that actually general supply and marketing services are not strictly are not in relation to tangible goods, such that they do not impact or affect or change or constitute work performed on goods from a VAT perspective. The recent circular that's been announced that was given by Gazette on Article 33 has really showed a very, very narrow interpretation on this related to tangible goods point, whereby even the service of marketing for an overseas principal of their goods in Saudi Arabia actually ends up being subject to 5 or 15% VAT in the Gazette's eyes. Whereas again, we consider that it should be zero rated. So they tend to look through supply chains. They see benefit in Saudi Arabia, where from a strict VAT technical perspective, we do not. And also there's a force of attraction to tangible goods, bringing the charge to tax into Saudi Arabia, where it could otherwise be zero rated, if there's any relation at all to tangible goods. And if you are performing, any sort of marketing services for overseas principals or parents, I would advise you to have a look at that circular that Gazette issued, if you've not done so, because the narrowing of the ability to zero rate exported services is going to prove problematic for some businesses. And it's going to lead to those assessments. It's going to lead to that controversy through the objection route and the GSTC and Higher Appeals Committee. So a really narrow interpretation of this article. Be very careful with zero rated services because Gazette often sees these as subject to the standard rate of VAT, causing an absolute tax exposure. So I think that's enough from me. A very brief run through. I know, happy to take questions on this at the end, but without further ado, I will pass on to Martin and Robin to talk more about e-invoicing and real estate transaction tax. Thank you.
Yes, thank you, George. So as George mentioned, I will be talking about e-invoicing, and after that about the real estate transfer tax that was introduced recently. My name is Maarten Schreuder. I'm the VT partner in our Jeddah office of Deloitte. So nice to be with you and talk about these topics. Can we move to the next slide, please? So what I intend to do is basically talk you through e-invoicing, maybe first from a bit more global perspective, and then gradually zoom into what sort of models we see around the world, and what we are expecting to happen in Saudi Arabia. We think that the whole e-invoicing topic basically comes from the request for transparency. There's a global trend going on tax transparency, as well as there's a digital tax agenda, basically meaning that both governments and businesses want to automate anything that relates to tax, simply to make it more efficient and effective. Obviously, for the businesses, maybe an efficiency matter, and for the governments, an effectiveness matter. And on the side of that, the tax transparency. So governments want to have better insight in what is happening and what transactions are taking place. That's not only for indirect tax and VAT, but actually also for direct tax matters. We see a lot of discussions around that on OECD level also. E-invoicing is something that is actually already applicable in quite a number of countries. So a lot of countries have implemented some sort of form of e-invoicing. The different models we will come to later on. Some countries are still thinking about it, and some countries are really taking steps, like Saudi Arabia. So what is the reason to go for e-invoicing? On the one hand, it's to enhance compliance with the rules, also to make sure that companies follow the rules and make it easier in the end for companies to follow the rules. Obviously, a clear driver is closing the tax gap There's always, let's say, a theoretical amount of tax revenue for a country and the actual tax revenue for a country, and often there's a huge gap between the two, and that basically has to do with shadow economy, people not reporting things, etc. The obvious reasons. Governments like to close that, and it's clear from the guidance that has been published by the Gazette so far on the KSA e-invoicing that one is one of the drivers behind this. And maybe last but not least, an important one is also to facilitate trade. And it might sound a little bit strange if the government is asking you to change your processes, to change your IT systems, change your way of working, which obviously has quite an impact. But on the other hand, once everything is in place, the experience of most businesses is that it is simplifying things, because you are then in direct communication with your customer on the invoicing and the payments, whereas probably for a number of businesses, you're actually already doing that on the order side, where you exchange information automatically. So this is just another step of sort of closing that circle. Another thing that is maybe driving this e-invoicing, not necessarily for Saudi Arabia, but globally, is obviously COVID. Like this session today, normally we would have done that face-to-face. But I think we all are experiencing that doing things in an automated way, doing it on digital platforms actually works in many cases quite well. So also e-invoicing fits into that. We mentioned that we foresee that the introduction of e-invoicing will also have yes, of course, maybe the starting point, because VAT is a transactional tax where invoice plays a central role. And as such, e-invoicing is important for VAT. But also the reporting of transactions from a VAT point of view links with, for example, withholding tax returns that are being filed, or transfer pricing. And it is much wider than just VAT only. So we clearly expect that this will result in further changes. It's not just, let's say, us talking about it, but before it would be nice to show you, just as an example, 3 pieces of publications, and we highlighted some of the, let's say, the things that stand out in these publications. So e-invoicing brings standardization. It should bring simplification as well, but since there is quite a big difference between what the different countries implement and the rules that are set, basically you will see that on a universal level, on a global level, there's quite a lot of difference, and that creates sort of a, as it is referred to in that article, patchwork of regulations, basically triggering complexity and confusion. Again, I think that is something that over time, and that's not going to be next year, but maybe in 5 or 10 years' time, probably there will be further global standardization of this matter, and then things come together and really make life easier. It's going very fast. Can we go back one slide? Yes, so the invoicing initiatives are going very fast. We see it, let's say, if you look back maybe 20 years ago, it was something very special, but gradually over time you see it happening in all areas of the world. And it's actually not only e-invoicing, but also the standard audit files for tax is one thing that countries are looking into. Again, all against the background of combating tax evasion and having more control on what is happening. In the end, it should all result in simplification in terms of invoicing to your customers, but also in terms of reporting your transactions. That's simply said, but it is in the end the purpose of the whole thing, of course. Yeah, can we move to the next one? So what have we seen over time? Basically, when you look back in time, in let's say 20 years ago, a lot of companies were modernizing their ERP systems, trying to automate more things, and ensure that systems are able to make use of electronic data interchange systems and stuff like that, so to make communication of data easier. I think approximately 10 years back, there was another sort of shift in that or update in that respect, where systems, ERP systems, were looked at again and enhanced, and basically really using the electronic data interchange systems to share information between vendors and buyers, or suppliers and customers. And nowadays, I think we're moving towards even more sophisticated systems, often cloud-based, where there's real integration, and basically we see clients that have systems where their vendors or their customers actually work in their systems to approve transactions. Why is that all important? Because you need to see that against the background of invoicing. As said, invoicing is an invoice is basically the most important document in the world of VAT. An invoice includes a lot of details on the transactions that are taking place. It shows who is the supplier, who is the customer, what the amounts are, what is being supplied, when it's being supplied, etc., etc. A lot of data that in the end all determines the VAT treatment of your transactions. Well, the data is on invoices, but actually that data comes out of your system. So in a sense, you could say that anything that is currently on an invoice must have been in your system at some place. Now, if you keep that against the sort of the development of systems throughout time, then it makes sense to say that we are moving away from paper invoicing, because it's really no longer necessary. That information is already in your systems, and you can just simply share that with others through digital networks, and that is something that will evolve over time. It's also some, let's say, a change that you cannot hold. It's just happening, and it's in a way it's good maybe that it's a little bit forced, because it will bring in the end, let's say, a better world, if you want to put it like that. And I think overall it would be best if it is indeed a mandatory e-invoicing system, because that enhances standardization, and basically also the scope of use of e-invoicing. So hopefully by some time we're somewhere in the digital future, all using e-invoicing, no paper anymore, and just simply exchanging data and in a rapid way perform transactions. It's a trend globally, as said, so a lot of places around the world. I think Latin America was one of the first regions to implement e-invoicing. Western part of Europe, we've seen that as well. Later on, it was in Asia, the eastern part of Europe as well. And it's actually interesting to see that the systems of the countries that moved towards e-invoicing in a later stage are actually much more sophisticated and much better than the systems of the early adopters. So in a way, maybe Saudi Arabia is at the right point in time, and maybe it's good that we, let's say, didn't do it in an earlier stage. Can we move to the next one? Okay, so a lot of general things on how e-invoicing has developed, but the big thing, of course, is what is an e-invoice? And it's simply said, a set of data that is structured in such a way that others can also read and process that data and verify it. So basically, the conditions that we currently have for paper invoices, of course, are standardized in order to make sure that everybody is using the same data and that everybody can process invoices. Basically, that same principle is applied when using e-invoicing. The good news for e-invoicing for the governments, obviously, is that they can easily tap into the information that is exchanged. And in a way, if you use a model where the government is involved in that flow of information, then there's also a moment for the government to check that information. Globally, you see more or less 5 different models for e-invoicing. So we have a direct model, an indirect model, a hard clearance model, and a soft clearance model, and a blockchain model. Maybe to start with the last one, the blockchain model, obviously based, as the name says, on blockchain technology, could be a very good solution in terms of combating fraud and having more control on transactions, transparency, etc., etc. There are many, let's say, many good reasons to use a blockchain system. The difficulty is, however, that the technology as such is maybe a bit in an early stage. Yes, we have blockchain already for quite some time, but still in its early phase. And also around the world, I don't think there's any government that has applied this in, let's say, on a national scale. It's sometimes used for contracting or some smaller areas of business, but applying this on a national scale, we have not seen yet. If you look at the direct and indirect model, those are basically models where the government is involved, but is not necessarily involved in the information flow. So the governments, the authorities, tax authorities, set the requirements for the e-invoicing. They set the standards. They appoint licensed parties, etc. But they are not necessarily themselves involved in the information flow. Whereas if you look at the clearance models, those are models where the government is in the information flow. So not only setting the requirements and the details and providing licenses, etc., but also really receiving the information when transactions occur. That is the big difference between, let's say, the clearance models and the other 2 models. In the direct model, it's basically peer-to-peer, so meaning that a supplier and a customer directly exchange information in accordance with the standards as prescribed by the government. The indirect model works in a similar way, so the authorities give the requirements and the standards, but there is an access point involved, basically meaning that the supplier reports to someone or a party that is specialized in e-invoicing, and that access point then reports towards the customer. So you're basically making use of a party in between that is then generally certified by the authorities. The direct model is a model that's used in Estonia, and the indirect model is, for example, used in Singapore. The hard clearance model is a model where the authorities again determine the let's say the design requirements and the requirements to the systems and the data format, etc., etc. But the government also plays a central role. So can be with access points or without. But generally speaking, a supplier would report to an access point. The access point reports to the government. The government checks your data when you provide that. If they agree with the data, then they pass it on to another access point, and that access point passes it on to the customer. So basically, if you have a hard clearance model for e-invoicing, then transactions can only be completed if the government agrees to the transaction. And so there's a sort of upfront control or pre-approval of your transaction. The difference with the soft clearance model is it's more or less organized in the same way, so with access points and the government taking a central role, but the control doesn't take place at the time of reporting or sending the data, but often takes place a few days afterwards. Italy is a country that is using the hard clearance model, and for example, Costa Rica is using this soft clearance model, and it does work for the government in terms of closing the gap, because we've seen that the tax revenue for Italy, for the Italian tax authorities, went up quite a lot. They closed their gap for a large part by using this hard clearance model. Can we move to the next slide? Then looking at what is happening in the KSA. So I think at the moment we only have seen the tip of the iceberg. There has been a regulation has been published. We know a little bit about what the rules will be, but there's still a lot uncertain. What do we know? We know that there will be no more paper invoices. We also know that there will be no more scanning of invoices in terms of trying to treat them as e-invoices. We know that it will be applicable to all taxpayers that are resident, as so non-resident companies are not immediately faced with e-invoicing. But if you are, let's say, a non-resident with a branch in the KSA, then obviously the KSA branch should fulfill those requirements. The content of the invoice will be the same as what is for the paper invoices, so there's not really a change there. But then again, anything that you can put on an invoice at the moment, a printed invoice, is apparently in your systems, so that should not be the biggest worry. The deadline for having e-invoicing in place is the 4th of December next year. So we still have a year to go to come up, let's say, with the solutions and the integration of that. The interesting part here is that the Gazette has announced that they will do it in 2 phases. So phase 1 would be that every taxpayer is able to produce and issue electronic invoices and to store electronic invoices. Phase 2 would be the connection with the Gazette. So initially, you might be looking at a sort of an indirect or direct model for e-invoicing, but in a next phase, that will be a clearance model. Systems should look like in an early, because otherwise you might be building something in your systems that later on need to be changed or updated for the second phase. There is a promise from the Gazette to provide the details on the requirements basically 180 days from now, so that would be somewhere halfway next year. In any case, I think it's good for companies to start thinking about, let's say, how are we organized at the moment? Are we confident that our master data would be able to deal with this? How are our journal entries set up? Can that be connected to an e-invoicing system, etc., etc.? It might also be wise to talk to your ERP providers to see what their plans are. Are they going to come with a module that you maybe can integrate in your system? That sort of questions, I think, are probably the things that you need to start thinking about at the moment. That's what I wanted to mention about e-invoicing. The other part of what we wanted to share with you is around real estate transaction tax. So real estate transaction tax is basically a tax of 5% that was introduced on the 4th of October this year and that tax is applicable to all real estate transactions. So on this slide or on your screen, you see a number of different types of real estate transactions that would be subject to the 5% real estate tax. It is, let's say, covering, in essence, land, buildings, so warehouses, factories, offices, shops, houses, can be any sort of real estate, but it is also covering rights to real estate. So it's not only, let's say, bricks, but it could also be contracts. Moreover, also the shares in real estate companies are covered. So in our view, real estate transaction tax has quite a wide scope. And as said, but different from the 5% is not deductible. It's a hard cost to the business. Next, please. So here we have listed as a sort of an overview of the treatment before October and the treatment on and after 4 October of different types of real estate transactions. So basically the sale of real estate, whether it's commercial, residential, since 4 October, exempt from VAT, but subject to 5% VAT. Certain leases of commercial real estate will be subject to VAT as well as 5% VAT. And you'll see that in general, rents will only be subject to VAT and not subject to real estate transfer tax. And the underlying reason is that what we want to tax, or what the Gazette wants to tax with the real estate transfer tax, is the transfer of possession, or something that is very close to possession. And that's why they make, let's say, a distinction between lease, long-term leases, and short-term rents. Next, please. In the past, we had an exemption for VAT in terms of first houses for Saudi citizens. That VAT relief has changed in a full exemption, and on top of that, a relief up to 1 million real for real estate transfer tax as well. Any, let's say, construction services and building materials, etc., that's not affected, although that ends up in real estate. It is in itself not considered real estate. Then there's the question, of course, always on the recovery of VAT. In the past, that was generally recoverable because the sale of real estate was taxable. Since the 4th of October, in principle, the sale of real estate is VAT exempt. So that means that the VAT that is related to or on the costs that are related to that sale is not deductible as well. So VAT really becomes a cost, basically. That is not in all circumstances the case, but it is a very important one. If you do a real estate transaction, it's not only about, do I need to pay 5% VAT on the sales, but it's also about, can I recover VAT on my costs that are related to the sale. Yeah, and maybe to close off on the list, use-work rights for a period of more than 50 years basically place you in a situation where you are taking a position of owner, and you're almost in the same position. That's why it's subject to 5% VAT, but it could still be also subject to 15% VAT. Recommendation here would be, if you have a real estate transaction, talk to your advisor about it, because often it's not only the VAT impact, but also the VAT impact that comes in play, and which is important for determining the value, or sorry, the price that you want to charge for the sale. The good thing is that the VAT legislation also includes a number of exemptions or reliefs from VAT. So we listed a few here, which can be transactions in relation to gifts. Inheritance is also exempt. There are exemptions in relation to transactions between funds and trustees. The contribution to the capital of companies, certain companies could be exempt from RET with a clawback period of 5 years. And I think what is an important one is the, let's say, real estate, and that will probably be important this year still, the real estate that was already sold in the past, but is maybe then, let's say, from a RET perspective, transferred after the 4th of October. Also there you get complexity where you have VAT on the one hand, maybe already invoiced, and on the other hand, potentially paying RET. Next. Further characteristics of this tax, the transaction value. So you pay 5% RET on the price that is agreed between parties. However, that needs to be compared with the fair market value, and if the price agreed between parties is below the fair market value, then RET is due on the fair market value. Notarization is very important. So RET is due at the moment of notarization, but there will be real estate transactions where no notarization takes place. For example, where the real estate is actually a right to real estate rather than, let's say, bricks in itself. Then it's the signing of the contract instead of the notarization that triggers the moment that RET becomes due. Very important to keep in mind that even if your transaction is exempt or excluded from RET, you still need to report it. So every transaction needs to be reported. You can only complete transactions if you have done that reporting. Otherwise, it's simply not possible to complete your real estate transaction. And furthermore, I think to point out important is that in principle, it's the seller that is liable for the RET due, but there is a joint liability for the buyer as well. So in the scenario where you are acting as a buyer, given the joint liability, you want to maybe take extra measures to be protected. And in that sense, you could agree, for example, with the seller that you as a buyer will do the reporting and the payment of RET. And in that way, you mitigate the chance of assessments at your end. Next, please. Yeah, just listing for your reference. As with every tax, there are penalties. It's good to know them. Obviously, nobody is looking forward to let's say, do transactions that in the end are subject to penalties. Maybe to point out in that respect, there is also in the legislation certain anti-avoidance rules, which basically also trigger liabilities or risks for other parties that are involved in the transaction. So it's not only the seller and the buyer, but maybe, let's say, as a tax advisor, if you are advising on a transaction in a very aggressive manner, and it's perceived as tax evasion, you might also end up in trouble. I think that's more or less it, what we wanted to share on RET, if I'm not mistaken. So I think we can move towards sort of the Q&A session.
Yes, Martin.
Yeah. Any questions?
Yeah, thank you, Mr. Martin, and thank you, George, for your wonderful presentation. We appreciate all the people who took pain in preparing this presentation and giving the presentation very quick time. Now, there are some questions which you have received from the portal. Does it going to
It will be done in 2 phases, but the first phase would be that every company needs to be able to, let's say, issue and store invoices in e-invoices. But there will be a moment where your ERP system is in a way connected to the Gazette. I don't think it will be a situation where the Gazette, by their own initiative, can look into your system, so that they have, let's say, open access, but there will be a connect phase to provide your information to the Gazette.
That means the system of all the must be compatible with GAZT system, or any
yeah,
system
that's obviously a bit of a question, because the Gazette, but what we see generally around the world is that there's sort of an interface, so that the Gazette will have its requirements, your own system has certain requirements, and then probably there will be what is often then referred to these access points, parties in the market that are licensed basically to act as a connector for sharing that information out of your system into the systems of the Gazette. Yeah,
because this question is mainly for the small and medium enterprises where their system is not compatible. It may be a burden on them to devise a new system or develop a new system just to compatible with the GSGT system. So,
yeah, fully agree, and that's why we see in many countries that there are, let's say, players in the market that will be having that intermediary role, so that the smaller businesses don't have to make a huge investment in an IT system. It's basically impossible.
Yeah. Now with the current technology in place, probably we can generate system invoice from any this thing. Now, how do you differentiate between the e-invoice, the fake invoices and the e-invoices? There is a lot of invoices which look like e-invoice, but it may not be e-invoice. So
yeah, that's indeed trouble, or at least there's always a risk of fraud. Although I think where let's say the requirements that will be set for the IT systems that will be set by the Gazette, those will be probably quite strict. So in general, you could say that the risk of fraud is lower when you automate, but let's say completely excluding that is almost impossible. In that sense, you could say that a blockchain system probably is the best option if you want to rule out fraud, but also there, and you've seen that probably in the news with Bitcoins, fraud is still possible.
Yes.
You can come up with smart solutions, but it will always be someone that's smarter than you come up with some sort of a scheme.
Yeah, thank you very much. There is a question from Neha Soni. She wants to know, how does the e-invoicing reduces the tax gap, or reduce the fraud and increase the tax revenue?
Yeah, so basically you could say that the e-invoice closes the tax gap simply because it is no longer possible to conduct transactions without reporting it. You can no longer, nowadays you could say I sell something in my shop and then I don't issue the invoice and I stick the money in a separate drawer. But that with e-invoicing is basically impossible. And the same goes with, especially if you would have a system where, let's say the hard clearance system, where you basically have to report to the authorities before you can complete the transaction in full. And there is no gap anymore. But as said, people will come up with smart ideas. There'll probably be always a way to avoid the system a bit.
Probably it will be this thing for the hackers, probably who may do something, and it may be a troublesome, at least in the beginning, till we get used to the system, the new system.
Yeah.
Okay, there's a question wherein they say this is regarding the VAT. Purchase order is before 31st July 2020, but invoice is raised in September 2020. What is the VAT rate? 5% or 15%?
Is that maybe George? Is that some?
I'm fine to address that. So it was a it was a purchase order you mentioned, Srikant? Yeah.
Yeah.
So
the contract is before 31st July. The
Mm.
purchase order is before 31st July, but
Okay.
invoice is raised in September 2020.
Yeah, so look, the relevant date for the cutoff for any transitional relief on contracts for 5% is the 11th of May 2018. And you would either have to have a contract that was signed before that date, and also the customer would have to be able to recover all of its VAT. And you could then continue to apply 5% to the supplies made under that contract. Now, the question is, does that purchase order constitute a contract? So is it effectively an agreement for someone to do something for someone for consideration? So do we have an offer, a consideration and an acceptance signed by both parties? Because again, this is going to be something that the Gazette will take a narrow interpretation of. So you would have to have, first of all, the contract signed before the 11th of May 2020. The customer would have to be able to recover all of its VAT, and in some instances, from some sectors, would have to certify that. And then you have an option to continue to apply 5% VAT to supplies made after 1 July 2020 up until the renewal of the contract, the expiry, or at the very latest 30th of June 2021. Now, there is another relief. If you issued an invoice before 11th of May 2020 to anyone for a supply that was going to be delivered afterwards, then that could also potentially be subject to 5% VAT. Again, application of this is optional. It's not enforced. The supplier has the option of whether to do it or not, because the risk sits with the supplier. However, in your example, if you've got a contract that was signed after that date, an invoice which was issued after that date, the supply would actually have to have taken place before the 1st of July 2020 for any sort of, for 5% VAT to apply. Otherwise, it's 15%.
Thank you very much. You're talking about the structured invoice format, e-invoice format. Is there any format that is available right now, which we can show to all the participants, or it is still in the development stage?
You mean a format for an e-invoice?
Yeah.
Basically, it's not possible to show that in a sense that that data is currently not available. So
okay.
we basically don't know, let's say, what the requirements will be of the Gazette. The only thing that we do know for sure is that the data that is currently on your invoices, on your printed invoices, that will also be the data that you need to have in the data set that is going to be that electronic invoice.
Currently, what is happening, even though we are generating the invoices from the system, but we tend to take the printout and signature and then send it to the customers, because customers generally don't accept any invoice without the proper authorized signatory. So does it need a digital signature, or if we take a printout and send it, will it be accepted as e-invoice?
Yes, basically you would be sending any printout, anything. You could say maybe even sending something you could see. So it will be just a file that will be sent over. Yes, there will be certainly requirements of, let's say, authenticity of these messages. So there will be a place to secure that it's a valid and true message, and that it's not being changed when being sent, or that it's not being changed when received. But again, the requirements still need to be set by the Gazette on how they would like to see that. But that there will be some sort of a, let's call it then indeed e-signature, or maybe e-stamp or something similar. That's likely, yeah.
Okay, generally when we have the credit customers, we can think of these things. We have a cash customer or a just ad hoc customer, walk-in customer who insist on the invoice. So how do we deal with such situation?
Yeah, that's a good one. but I think because in the current rules, there's no, or I should say, in the current VAT rules, we have simplified invoices, so they're invoices with less requirements. But in the e-invoicing rules, they're simply referring back to what is currently in the implementing regs. So there's no, as far as I've seen, there's no mentioning of maybe a threshold or something saying that smaller businesses are relieved from this, or that, let's say, over-the-counter sales are relieved from this. And probably the reason is that if you would, let's say, open a small gap for people not to be covered by these rules, then lots of things will go through that small gap, right? That's the problem.
Yeah, Shekhar sir, I also have received few questions, actually one-to-one, and the first one, it seems to be for George. It is related to VAT. So the question is, we are importing large amount of equipment into KSA every month, which is now impacting our cash flow due to 15% VAT rate. How long does it take to obtain Article 44 approval? So I think they're referring to the deferral,
to the deferral of the import VAT. I've not seen one yet. It seems to be one of these instances again where KSA, much like the foreign refund claims, isn't ready or doesn't have the system. That doesn't mean you can't apply for it. And actually, for a business like that that's suffering huge working capital disadvantage, whilst there may not be a mechanism or indeed a form or an area in the portal or the ARAD system where you can apply for this, it would not hurt to write the application, to be able to demonstrate the behaviours that you, a good taxpayer, that you want to apply for approval to report VAT through the VAT return, because Saudi Arabia has just showed that it can do that. It has it allowed deferment of import VAT through to the VAT return through its initiatives recently under the amnesty and all of the measures to stimulate the economy. That was one of the key pillars of its initiatives. So they've shown they can do it, and I think it's the right time to be writing to your relationship manager or otherwise contacting Gazette to say, we understand we can have this deferral under Article 44, I think you referred to. We want to have this and see where it takes you. There's no harm in starting the conversation now, because once that system does open up, there will be a long queue for it.
Yeah, thank you. Thanks, Josh. I also have one that is more of related to litigation, and probably if Rena take it up, then change in the GSAT process at the objection level. We have been asked to attend the hearing post filing the objection, which were not the case earlier.
Do you mind if you repeat the question, Robin, please, at the end?
Yeah, please. So it says that, is there any change in the GSAT process at objection level? We have been asked to attend the hearing post filing the objection, which were not the case earlier.
No. So currently, when you file an objection at the Gazette level, recently they have been introducing hearings. So they've been asking taxpayers to come to hearings, virtual, of course, which could discuss the case. The hearing is just part of the objection process, and a decision will come based on hearing that is conducted. Following the hearing, of course, and the decision that is issued by the Gazette, if the taxpayer is not happy, then you may also appeal at the Tax Violation Dispute Committee level at the GSTC.
Perfect. So this is similar to the earlier one only. And I would say that more or less similar to the appeal that we file at GSTC level. So thank you. Thanks, Renat, for this.
Yeah, there is one question to Mr. Martin. This is regarding the real estate transaction tax. On slide number 17, you are saying that the lease of commercial real estate, there is a VAT of 15% on or after 4th of October, and also real estate transaction tax 5%. You mean to say there is VAT as well as RETT applicable to these commercial real estates?
Yeah, that can happen. So let's say on the VAT side, so the VAT rules basically say that the lease of real estate, commercial real estate, is subject to VAT. That's relatively straightforward. On the other side, we see that the real estate transaction tax rules basically say that they want to levy 5% VAT on real estate transactions, and what is then described as real estate transactions, and I have it actually next to me, but it is covering all sorts of real estate as such. So as said, things like buildings or land or parking spots, antennas, oil rigs, whatever you can think of. But it also covers long-term lease rights, barters, rents, finance lease. So it is not only, let's say, real bricks that we see, but all sorts of contracts can be covered as well. What I think what we need to keep in mind is that what the Gazette tries to tax is possession, and the transfer of possession of real estate. So where a lease contract would put you in almost the same position as owner, then it's quite likely that lease contract is subject to 5% RET. Most lease contracts or rental contracts will probably not put you in a position of owner or almost the same position as owner. If you sign a contract to rent an office for 4 years or 5 years, I'm pretty sure that will not be subject to RET. But as the longer the term of the agreement gets, the more rights you have to that building, the more likely it becomes that it's subject to RET.
Thank you very much. This 5% tax is on the lease amount or lease plus VAT? Suppose the lease amount is 100, VAT is 15. The 5% is on 100 or 115?
That's a very good question. Didn't think about that earlier, but I would say that the RET is due on the price that is agreed between parties, unless the price is below the fair market value. So as long as your price is above the fair market value, I would say that it's the lease amount excluding any VAT.
So there is no tax on tax, basically.
I don't think that's the intention, no.
Okay, probably the VAT, the JCT people may come back and say, no, it should be based on the including VAT also. So they want to generate more revenue.
Yeah, potentially, yeah.
Okay, my last question would be, in the current scenario, probably we can make use of the expertise of the Indian IT people who already expertise in the GST implementation and the e-invoicing. How we can take up in Saudi Arabia. So this I'm asking as a SIBN Finance Committee member, so that we can also enhance the business relationship between Saudi Arabia and India. So probably it's a win-win situation for both the IT people of India and the finance professionals of Saudi Arabia. They can work together and bring in that expertise.
Yeah, of course. Oh, sorry, go ahead.
How placed we are as of now in terms of e-invoicing in Saudi Arabia?
Yeah, so we know so then we know that there must be something in place December next year. We also know that further details on the requirements will be published in approximately 180 days from now. So somewhere mid next year, you will know a bit better what, let's say, what the requirements are. I would say if you are, or any of the participants, if you are connected with people in India, it's certainly worthwhile to have a chat with your connections there and see how it impacted their business and what they did, let's say, in initial stage when the e-invoicing was introduced in India. Obviously, we're not sure that the system in Saudi Arabia will be similar or comparable to India. It might be a completely different system, but there's no harm in sort of getting a list of pitfalls and let's say good ideas, right? And we see with a number of our clients, they actually are starting to look into their systems and to sort of try to see what actions would be required. Things like, is our master data sufficient? How are our accounting journals, how is that organized, and would that fit with any e-invoicing mechanism? So yes, there are already a few things you can do prior to, let's say, the publication of the detailed rules.
Yeah, thank you, Martin. Thank you, George. Thank you, Robin. Thank you, Aladdin, Irfan, and Renat Fahad for your presentation and taking time and preparing this at a very short notice. Obviously, there must be a lot of follow-up from Vijay Soni, who is the man behind this particular this thing. And also, special thanks to Madam Hamna Mariam, who has been the key person in arranging this particular event. Over to Hamna ji, please.
Good afternoon, all. We come to the end of our session on financial regulations conducted by Saudi Indian Business Network. So as all of you know, I don't know if most of you know, because I see a lot of new faces, people who are not part of the Saudi Indian Business Network too. So it is an organization which works under the patronage of the Ambassador of India. So we would like most of you to be part of Saudi Indian Business Network. So all of you can go search SIBNKSA.com, SIBNKSA.com, and then you can apply for membership. We have a dedicated sector for finance, so you could all be part of it. And for this very important session, which would add value to the nascent tax regime in the kingdom, I thank Mr. George Campbell of EY along with his team, and Mr. Martin Schroeder and his team from Deloitte. Thank you very much. I also thank Mr. Vijay Soni, not part of this session now because he had a meeting, but actually this was his brainchild and his effort. So I sincerely thank Mr. Vijay Soni, General Secretary of Saudi Indian Business Network, for organizing this event. Warm regards to all of you. Have a good day. Thank you.
Thank you. Thanks, everyone.
Thank you. It was a pleasure. Thanks.
Thank you very much. Thank you.
Thank you, everyone.
Thank you.